This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. I have with me this morning John Rubino, well-known author and publisher of the website dollarcollapse.com. Good morning, John. Welcome back to Macro Analytics.
Yeah, I like the new video format.
Well, it's challenging for us non-technical kind of guys. But
you're an engineer; you can handle it.
Well, maybe, but I'm an old engineer, and quickly we get data. But I'll have some finger problems, but we'll try and make this work as we go here this morning. John, I actually wanted to springboard from the video that we did 2 months ago on financial repression in the EU. And a number of things that have developed since, and the articles, a couple of the articles that you put out recently, which I just think shows you the absurdity of the levels that we're reaching. I have up this chart that we spent a lot of time talking about here over the last couple of years, and I believe that we're now up in that top quadrant where we've got malinvestment, dysfunctional markets, and delusion going on. And most of our listeners have heard us describe and build that, so I'm not going to bore everybody, but that's what we're at, where we're at. And this whole world of financial repression has been building on itself, and I believe very firmly that it really started accelerating in 2000 with reaction to the dot-com bubble, and how we would get ourselves out as we really went to zero interest policy, then subsequently to quantitative easing. And so what's happened, the financial markets are completely disconnected from Main Street and the real economy. And I think most of our listeners are well aware of that. And as we push more and more money in, and the government becomes a larger percentage of the money that's being spent, deficits, whatever, never mind the Federal Reserve's balance sheet, what's happening is, because we're a 70% consumption, the propensity is losing its power. And so financial repression is becoming more and more difficult, man, for the engineers, if I can say that. And this is a chart that shows every time we get into a problem, we resort to various techniques, financial repression, where financial repression I'll define as negative. You can define it many ways, but it's government interference in a way to using regulatories to move and moderate the behavior of society in a way that the government wants you to behave or to react. And the biggest tool in that is to use negative real interest rates, because by doing that, you make the debt of the government, because that's what it's all about, financing the government debt. You make it cheaper, and you force people into riskier and riskier assets so that pensioners and savers are really hurt. And this chart shows you that every single time it's getting harder and harder and more difficult for them to do. And and when I read your two articles, it just showed the absurdity of it. What prompted you to write them?
Oh, well, so much has been coming out lately about the stock market going up, and why is it happening? And the truth, once you get under the surface, is that corporate earnings are falling and corporate debt is going up, and yet stock prices are going up. Well, the reason for that is that that corporations are borrowing money to buy back their stock. And this is a perfect example of the corruption that flows from easy money. You convince people to do things that they wouldn't normally do because there's some kind of a short-term financial advantage to it. And, it works for individuals. You lower mortgage rates to a point where it's easy to buy a house, so people buy too much house and they buy cars they shouldn't buy, et cetera, et cetera. And it's working the same way for corporations. Corporate CEOs and other executives look at the rate of interest they have to pay on their debt, then they look at their dividend yield, and they realize that it's actually cheaper to borrow money to buy back stock than it is to leave the stock out there and continue to pay dividends on it. So they're making a rational short-term decision to increase their cash flow by buying back their stock with borrowed money. And that also serves to push up the stock price, which presumably gives them a higher year-end bonus, because a lot of corporate executives are compensated based on how well the stock price is doing. And none of this should be happening in a rational world, because what you end up with is corporations with, increase to the point of insanity amounts of debt on their books and less equity outstanding. And at some point that has to be reversed out, obviously. You can't buy back all your stock and remain a public company, and you can't take on unlimited amounts of debt. So this is a strategy with a limited time frame in which it can work without being exposed as the perversion of market forces that it is. And so presumably a lot of the guys doing it now are expecting to leave in a couple of years with really nice pensions and leave the problems of all this excess debt to their successors. So, which is a perfect example of how behavior changes in a low interest rate, easy money world, and in ways that you wouldn't expect rational, presumably honest people to be behaving.
Yeah, the what's going on with the buybacks is I would be strong, John. I think it's the biggest tax loophole that I've ever witnessed. They are not naive in the corporations. The boardrooms have just got to be outright laughing. You see Larry Ellison, he's going to buy $20 billion back. You've got Apple at 16 to 18 billion. You got IBM at 13 billion, et cetera. They can't buy them fast enough. And it is rational from their standpoint, because it's the money that they borrow is 100% tax deductible as a write-off, the money that they borrow. And then they take that and they buy back those shares at whatever price. And they avoid, for example, the dividends at 2.25%. And if they're borrowing the money at less than that, look at the payout. So you published the article and some of the research I've done, and it's a no-brainer. So they've almost right now are concerned about when they're going to close the loophole. But I don't believe that it's a loophole, even though I've used that word. I believe the government knows exactly what it's doing to incent the growth in the wealth effect. So they're giving corporations an absolute free ride. But the corporations, John, they know this gig is soon going to end. And I believe they have an exit strategy. They know what they're going to do. And my opinion, and remember I spent a fair bit of time in corporate life, is after they've bought back all these stocks and spent and have this amount of debt, I think you could see the biggest mergers and acquisition boom in history. Because what they're going to do is they're going to go out anywhere around the world, and anybody who's got real value, bricks, mortar, real assets, they're going to exchange this counterfeit paper, which is their currency, which is called their stock, and they're going to buy assets. Hopefully they're going to be accretive. Hopefully. But they're going to buy those companies. They're going to pare them back. They're going to do the mergers and acquisition, a private equity game where they're going to strip the employees out as hard as they can, because they'll use their own synergies, if we can use that, and they will load those corporations up, their balance sheet, with that debt and write it off again. And in some cases, John, just the last point, the government, they're going to move some of those companies are going to move offshore, because then they're going to get another tax break. And I think that the government doesn't realize the gig that they have got themselves caught in right now, because they think, oh, this is going to work.
Yeah, that would be one of the unintended consequences that we'll talk about today. But yeah, you start with incenting more or less ethically questionable behavior in these stock buybacks that pump up the stock price. And then you get to what you were talking about, where companies feel like they have to buy out other companies and then strip the assets in order to maintain the facade of corporate health. Exactly. And again, these are all things that don't happen in normal times, Corporate executives don't go around looking for companies that they can loot, and they don't actively fool their shareholders into thinking that earnings are going up when they're really not, just because the share base is shrinking. You know, IBM is a really good example of this. They've had lower revenues for the past 2 years and lower earnings before interest and taxes during that same time. And yet their stock price is near its 12-month high. And why is that? That's because they've been borrowing huge amounts of money to buy back their stock, you know, take stock off the market so that existing earnings are divided into fewer and fewer shares, which makes earnings per share go up, which makes the company look healthy and well run. And it's all a facade. And in their last earnings report, though, people seem to start to figure this out because earnings per share went up. You know, they met analyst expectations, and yet the stock went down. And that could be a sign that people are finally starting to figure out that earnings per share is not a relevant stat anymore, that you got to look at earnings before interest and taxes, because that strips out the tax break that you get for this buyback strategy and shows the impact of the interest costs. And so when people start analyzing a company in that way, they're going to start seeing that the results aren't nearly as good as earnings per share indicate that they are, and they'll start valuing those companies accordingly. So you know, as we said, this has a limited time frame in which it can work, because at some point analysts are going to figure out that it's a scam, and then everything changes. Then corporations have to go to Plan B, whatever that's going to be.
Yeah, John, you're absolutely right. I've done the analysis with EBITDA and looked at in the G4 and the S&P 500, and EBITDA has not only been steadily, that's earnings before taxes, interest, and depreciation, has not only been falling steadily here for the last 2 years, it's about to go negative, which means it's at a burn rate in these corporations. So because they've got lots of cash on their books, doesn't mean they're now cash rich. I mean, the cash is there because they borrowed it, or the cash they were making before that was free cash flow. That's changed. And the valuation of a company, enterprise value, is based on its free discounted cash flow. And every analyst out there that can get a CFA knows that. So I'm sure it's starting to sink into them, the degree at which this has shifted. But you know, it's pretty hard to give a sell recommendation when the market's going up.
Got to wonder why they haven't figured it out yet. But,
well, they have. I think they're just
time is coming.
Their time is coming on it without question.
Yeah.
But you also brought out this discussion on pensions, which I had not realized what was going on there in terms of what the government's thinking of doing. I certainly am fully aware of the magnitude of how badly underfunded they are with low interest rates where they can't get the yield that they've got basis of 6 and 8%.
Yeah, a lot of corporate pension funds are already underfunded because, as you said, they just can't earn enough to cover the promises that they've made. And now the Highway Trust Fund, the government's program that gives money to states and localities to build roads and bridges, is starting to run out of money. But instead of just doing what an honest government would do, in other words, raising taxes to cover the expenses or scaling back the spending on roads and bridges to live within our means, they're thinking about changing the rules that govern how corporations fund their pension plans to allow governments to put less money in, which would increase corporate earnings, which would increase the amount of taxes that the corporations pay to the government, which would help the government then fund the highway program. So they would just assume higher corporate earning or higher corporate taxes coming in, and then use that money for roads and bridges going forward. But the cost, of course, would be even more underfunded pension plans that when the time comes to start paying for the retirement of cops and teachers in states and localities and workers for big industrial companies like GM and IBM, the money won't be there. And so we're basically, again, borrowing from the future to get through the present. And doing something that, again, a rational, honest person wouldn't do, but we're in such a bad situation now with all this debt that we feel like that's the only alternative that's left to us. It's
a tar pit, isn't it?
Yeah, it becomes this situation where you have no good options left, and all that's left to do is something that's going to hurt in some way. So you choose the least painful option without regard to whether it's the most honest option. And in so many cases now, people are choosing to lie or to hide the truth in order to get through whatever cycle they're operating on. Politicians operate on election cycles. Corporations operate on quarterly earnings cycles. And so you see them doing things to make the next report look as good as possible, regardless of whether it's the right thing or the honest thing to do.
I think these corporations, in regards to the pensions, if they do this, they're not going to contribute, absolutely, but they're going to end up using that money, and they'll borrow more money and take more tax write-down, so it won't end up generating more taxes. They'll use it as more tax write-offs in the corporation. So I think it's just spin that the government's using here in some regards. But the pension crisis that we're going to see, I personally believe, in the next couple of years is going to be astounding, John, because I don't think the problems are in the banks as much as they're going to be in pensions and insurance companies, because they're playing the game of chasing yield right now. That's their business. And the risk that they're taking to find that yield, because the shadow banking system, the games are going on, are just as bad as they were in 2008, except the asset-backed, the securitization products are different now. They're car loans. They're in a massive way, 16.2 million cars. We're selling more cars than we have since 2006, and subprime lending in it. We're seeing it in student loans that are coming through with $1.2 to $1.4 trillion. And frankly, in the whole retail space out there of stores and how they've been financed through REITs, I think there's a serious issue. So underfunded pensions and with profits at this level, highest profits we've had, that says, and you still can't pay them? What's the chance of they ever being paid? Ever.
Yeah. And see, that this pension thing is one of the unintended consequences that we've been talking about, because if a pension fund can't cover its nut, the amount of money that it needs to make in a given year, it can either go back to the plan administrators and admit that it can't do it, or it can, as you said, reach for yield. It can buy more risky assets and try to generate a high enough return for the guys running the plan to be able to come back and say, okay, we met our targets. And what that does is it creates the conditions in which, in the next market correction, which we will have sooner or later, stocks will go down by 20 or 30% in a given year. Junk bonds will get whacked, because they always do eventually. That's how even bull markets work. You have big corrections. Well, that's going to have an outsized impact on pension fund returns, because instead of, generating 6% instead of your 8% target, which is bad but not catastrophic, you're going to be down 20% on pension fund portfolio at some point in the next few years, and that will be catastrophic, because that when you lose 20% in a portfolio that needs to be generating 8% a year, that means you have to generate considerably more than 8% going forward to stay anywhere near even. And these guys, there still won't be any way to do it, because interest rates will still be low, and equities will still be overvalued if they drop by 20%. So we will, as you said, have a pension crisis in which these numbers come to light. And here's a prediction, though. Before that happens, they will start changing the rules governing pension reporting to allow them in some way to hide this fact, and maybe they'll smooth it out and they'll say, well, we'll go over 20 years instead of 10 years for the average return, and allow you, therefore, to show that if you assume higher rates of return in the future, that you'll be closer to fully funded, and so you can use that as your present day number and pretend that you're fully funded. Stuff like that is going to happen, or at least proposals will happen, and we'll chronicle them when they do.
Without question, John, the word financial repression is really the layman's street version of what the economists refer to as macroprudential strategy. And macroprudential strategy is using regulations, changes in the rules to redirect the economic investment climate. And so what I've just witnessed to show the acceleration. Janet Yellen just made a speech to the IMF here 2 weeks ago, and she was laying out her philosophy on the Fed and where it's going. She mentioned macroprudential strategy 29 times in that speech. 29 times. This is something we never used to hear occasionally. 29 times. As what she thinks, without laying out the specifics. We're going to change the pension rules, or they're going to massage those. But I just heard 8 days later, Stanley Fischer, newly appointed Fed vice chair, he made a speech specifically on macroprudential strategy because of what he did in Israel. Remember, he was brought as the bank over from Israel to become the vice chair. He was chairman of the Bank of Israel, where he had implemented it in regards to housing, etc. And he was talking about some of the issues in doing it. But a dedicated speech on it. Both of these are up on my site. What you can get out of that is not necessarily the steps that are going to unfold, but it does tell you where the priorities are and where the focus are. And so the listeners have got to gear up, because the things you point out in your articles, as obscene as they may be absurd, I think they're going to get to be more absurd, because we know when I showed that original chart with moral malady, and we talked about that, almost 3 years ago, John? It sounded absurd that we'd ever get to those levels up on the top right-hand corner, but here we are.
And the reason that these guys love macroprudential policies is that it puts them in charge. You know, in a free market economy, the bankers and the government basically have to sit back and let business people and investors make the decisions that govern the direction of the economy. And once you get into the realm of serious macroprudential policy as explicit government policy, then these guys are running things. They to intervene in any market they want to anytime, because that has become their job. And so it makes them feel omnipotent.
That's exactly what's happening, John. The balance of power of the legislation, the judiciary, and the executive branch is being usurped by unelected officials in terms of central banks. That's what's going. The power that they now have far extends what was ever intended or designed. So, we've talked about statism and centralized planning. That's what we've got at an accelerating rate right now. I don't mean to sound like conspiracy. This is just a fact of what's going on. Whether planned or unplanned, it's happening.
Yeah, when these guys start talking about, we'll leave interest rates low forever, but we'll intervene in whatever market seems to be getting out of control. There's an assumption there, which is that a human mind is complex enough to model an economy, a modern economy, and understand it well enough to know what tweaking this thing over here will do to that stuff over there. And that's totally false. A modern technological economy is vastly more complex than our ability to understand it. It's completely run away from anything that resembles an economy that could be controlled by a few guys at the top. Not that there ever really was an economy that could be controlled in that way and still operate efficiently. But now we're way beyond that. The idea that somebody in Washington can tweak something that's going on in Silicon Valley and improve it is insane. It's just not possible. So the unintended consequences are going to get bigger and more obvious as we dig further and further into things like capital controls. And we're already seeing it now with U.S. restrictions on citizens investing overseas. It's almost impossible for the average American to open a foreign bank account now, because no foreign banks want to deal with us anymore. Our rules are too stringent. And in effect, that's capital controls. That's preventing us from moving our money overseas by making it so hard that most people just don't want to do it. And it goes on and on like that, where we're already intervening in markets that most people think are free, but are no longer free. And so you can consider the stock market a manipulated market now, based on what we already talked about, plus central banks beginning to invest directly into equities. So you take those two things together, corporate buybacks generated by really low interest rates, and then central banks investing in the stock market, and that's no longer a free market. That's no longer a market where earnings really matter, or you can even measure earnings. So it goes on and on. The bond market, gold, silver are grossly manipulated in various ways, and we've just seen that various kinds of interest rates like LIBOR are being manipulated, or have been manipulated by the banks who were supposed to set it. And we could spend the whole session just going through point by point the kinds of manipulation that are going on out there that most people don't really get. They don't understand it's manipulation, but it's already happening. So we are so deeply into this that I think the unintended consequences of today's policy will be the big story of the next decade. You know, they're going to come back to bite us, and then we'll have to do even crazier things to deal with those consequences and so on. Until it ends in some way, and so the real question is, how does it end? You know, does the market just eventually impose discipline on all these bureaucrats who think they can run things, or does something else happen? You know, do we finally elect people who understand? I suspect it's going to be the market imposing discipline. It
always, historically, that's what happens. In the investors finally create that discipline. They can be delusional for a long period of time, but when the adjustment comes and the panic sets in, that's what happens. But we have such poor price discovery and so much mispricing that's going on right now that things have become completely delusional, if I can use that expression. John, we have to wrap right now. We're past our hard line. Summary comments that you could make regarding financial repression here?
Yeah. We've just scratched the surface here, Gord. There's so much more to talk about on this subject because this is the dominant force in the global financial system now. You know, it's not a peripheral thing that is nibbling at the edges of the marketplace. It is the market. So anybody who wants to understand the investment markets or fixed income or corporate governance has to look at government policy as it is being used now to manipulate the major financial markets.
They don't use the word manipulated. They say it's in the efforts of price stability and market stability. But the word stability is interchangeable now with manipulation. And you know, John, are there any areas you feel that you see that aren't being manipulated in some way right now?
Well, not really, because when you lower interest rates to an artificially low level, you affect everything. You know, the currency markets and the equity markets, and just that one piece of policy pretty much guarantees manipulated markets across the board. Because, you know, if you lower interest rates to a certain point, that's the same thing as pumping government money directly into the stock market, effectively. So you are manipulating equity markets by pushing down interest rates. And, you know, currency rates, the same thing. Commodities, name it, it's all affected by that one piece of policy perversion.
Once you move away from sound money, you've entered the tar pit. And it just gets stickier and stickier until it just pulls you right under. And then it starts to accelerate the more mass it gets below the surface. And so all these markets, whether they're being, quote, manipulated, but they're attempting to control them because it just keeps spilling. And you've done a lot of work on complexity. And in our world today, the complexity is, if central planning ever could have worked, it was not today. It was years gone by. Today, it's not possible with the complexity we have. So we're just waiting something will break. Got a break, John. Can you tell our listeners how they can learn more about your work and the things that you're doing and some of the things you're planning on writing on?
Sure. I run dollarclap.com, which is a continuously updated site that covers a lot of the stuff we talked about. My newest book is co-written with Gold Money's James Turk. It's called The Money Bubble, available on Amazon or also at dollarclaps.com. And I've got a lot of stuff in the pipeline covering financial repression and the unintended consequences. So something should be coming up later today.
John, we've just started another site at Gordon T. Long. It's called the Financial Repression Authority. And all that site is dedicated to is the kinds of changes and things that are happening that aren't getting visibility in this regard. And there's that much material that we had to break it apart. And to be able to do the synthesis and the analysis. And it's not a United States. It's right around the world as everybody's being forced into it. So I'm looking forward to what you have to write on it. You have to write on it. Talk to you next month.
Great. Look forward to it, Gordon.
John, all the best. Thanks again. Bye.
Thanks. You too.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.